deafening right now. We're going to pause and get some business news, but we'll bring you all the latest from Downing Street very shortly. Let's get that business news.
The price of politics. UK government borrowing gets more expensive as pressure grows on Keir Starmer to quit as Prime Minister. Pushing up the cost of living. US inflation jumps as the Iran war leads to higher energy costs. Oil prices rise again as President Trump rejects Iran's latest ceasefire proposals, and Western countries discuss escorting ships through the Strait of Hormuz. Welcome to Business Today. I'm Ramzan Karmali. Well, here in the UK, the pressure continues to mount on the Prime Minister to resign. 4 government ministers have quit over his refusal to go, and the BBC understands more will do so today. All this instability is being noticed on the financial markets too. It comes as Prime Minister Sir Keir Starmer continues to resist calls to resign following last week's poor results in local elections. Those financial markets are concerned about what the uncertainty could mean for Britain's beleaguered public finances. Well, joining me now is Colin Ellis, who's Head of Economic Research at the credit rating agency Moody's Analytics. Colin, thank you so much for joining us. We've seen some big moves in the last couple of days on the bond markets. We're seeing 30-year debt at their highest levels, yields at the highest levels since 1998, 10 years since the highest levels since the financial crisis. This just doesn't look very good for right now for the UK economy, does it?
No, it doesn't, Ramzan. And we need to put this in some context. So the highest since 1998 for some of the yields, the highest since later for others. I don't think this is a crisis mode yet, but I think this is a clear shot across the bows from the financial markets that they are focused on the UK's public finances. They are focused on that fiscal position, which is still really quite precarious. And if there's one thing that investors really don't like, particularly investors in government bonds, it's uncertainty. And we're now faced with the prospect, potentially, of a prolonged leadership election to be the next Prime Minister, where unless the candidates can be very clear about what they're going to do, I think that uncertainty will be reflected in higher interest rates that the government has to pay.
The worrying thing, though, is that the bond yields across the globe are rising at the moment in part because of the crisis in the Middle East. But the bond yields here are really rising quite sharply in comparison. Doesn't this make the UK a less attractive place for investors to look at?
I mean, any kind of political uncertainty, particularly when you're unsure about the direction of policy, will make you less attractive compared to other countries. But we're in a particular situation here in the UK where we still have a bit of an inflation issue. You know, the Bank of England is in a bit of a bind at the moment. And at the same time, the government is still borrowing a lot of money. We're expecting the government deficit this year to be about 4% of GDP. So that means the government isn't just refinancing old debts, it's coming back to markets and asking for even more money. And that's clearly something that's going to make them a little bit nervous.
One analyst note I read today suggested that if Sir Keir Starmer were to stay in place, or say where Streeting came into power, that would be a preferable option, say, compared to an Andy Burnham or Angela Rayner. Is that the right sort of call?
Well, it depends on what the kind of policy platform will be. I think there's certainly a suspicion that with some of those names, you might see a shift towards more borrowing and more spending, and that would be even worse for the UK's public finances. But I think if you have candidates set out a credible commitment towards getting the debt dynamics under control, getting that deficit down, getting on top of debt and getting that falling, that may go some way to assuaging some of the concerns. But it's certainly true that the UK is sticking out a bit despite everything else that's going on in global financial markets right now.
Colin Ellis from Moody's Analytics. Many thanks for your time.
Thank you.
OK, let's move over now to the US and the world's biggest economy. There's growing evidence that the war with Iran is having a negative impact across the economy. In the last few hours, we've had the latest inflation reading for April, and on an annualised basis, prices are now rising 3.8% in the world's biggest economy. That's a sharp jump from March's 3.3%. The biggest reason was energy, which accounted for more than 40% of the overall increase. It means that inflation is even further away from the central bank's 2% target Therefore, it seems less likely policymakers will vote for interest rate cuts anytime soon. Well, to get more on this, let's speak to Beth Ann Bovino. She's chief economist at US Bank and joins us from New York. Beth Ann, thanks so much for joining us. What did you make of today's figures? I mean, not a surprise. The markets were kind of expecting these kind of levels, but it does show how much energy is playing a massive part here.
The core prices and also total prices were exactly what we expected. Energy prices were driving the story. On core, one factor that probably nobody cares about right now is shelter prices jumped very highly. A lot of that was just tied to the BLS dealing with missing data during the government shutdown. What they had to do. Ultimately deflated shelter, so we saw a bump up. But the real driver is energy, and we're seeing some move into core as well, with airline prices jumping higher.
Now, this makes this very hard for policymakers at the Federal Reserve, and the political pressure they had been facing from the president as well, that interest rates need to come down. It looks less and less likely that we'll see a rate cut this year from the Federal Reserve, doesn't it?
Yes, it does. There's two things. The Fed is still fighting two tensions. Remember, the Federal Reserve has two mandates. One, stable prices, not happening right now. And the other one, stable or maximum employment. That's also a challenge. What do we see now from the data? Well, it says consumer purchasing power has been squeezed dramatically. If you look at real income, that is down. That's in negative territory. But the other fear is that we're seeing core prices picking up, and we also saw inflation expectations rise higher because of what's happening today with oil prices high. So it's not over. That means the Fed is definitely in a wait-and-see mode. We had been expecting a rate cut in December, but it very well could get pushed later than that.
And very briefly, I mean, we're not really seeing massive evidence on the labour market, though, that the war is starting to have an impact. But when should we start seeing that, do you think?
Funnily, the labor market, the jobs numbers, the job gains are certainly very meager. We saw a good number last week and another one the month before. But generally, we're looking at about 40,000 jobs a month being produced. That's still very small. So that's one issue. But the unemployment rate is still rather low as people have jobs. I think what the Fed's going to do is keep watching those readings. And if the unemployment rate stays at those levels, and even if we do see job gains hold up to around 50,000 a month, their focus is going to be on inflation. Maybe not all of the Fed, but certainly the majority.
Beth Ann Bovino from US Bank, thank you so much for your time.
Thank you.
OK, let's move on now to oil prices, and they've been increasing again as the standoff between the United States and Iran shows no signs of easing. A short time ago, a barrel of benchmark crude was trading at just over $108. It comes after President Trump said the ceasefire was on, quote, massive life support. And as the UK and France try to lead 40 countries in setting a military plan to escort ships through the Strait of Hormuz in the event the ceasefire is seen as stable enough. Well, to get more into this, let's talk to Paul Hickin, who's editor-in-chief at The Petroleum Economist. Paul, thanks so much for joining us. First of all, the price of oil, we've seen another increase where it's still way above that $100 mark. This is getting harder and harder, surely, for the global economy to be able to sustain this.
Exactly right. We've seen 1 billion barrels of crude come off the market over the past 2 months, and it's just going to get worse. We've seen this situation now where it's starting to already affect especially Asian economies with demand destruction, policies in place to move away from oil to try and manage the amount of oil that's coming into those markets. And you see the ripple effects around the globe to the Western economies, like you saw earlier in the program with US inflation at 3-year highs. And these things are only going to get worse. And the risk of stagflation is going to rear its head at some point if there's no conclusion or peace deal.
Now, the plan by the UK and France and these 40 other countries to try and get ships through the Strait of Hormuz, what do you make of that plan? Is that even likely to happen?
Well, I think at the moment the trade in the markets is nacho, which is not a chance Hormuz opens. And I don't see that changing. We've had these assumptions that we can somehow open the Strait of Hormuz before, and that's been shown to be incorrect. realistically, we've seen 90% of ships down from normal levels. It's really a question now of what moving parts can really shift the dynamics between Iran and the US. And China, with the meeting between Trump and the Chinese leader coming up, that could be a key moment to whether China plays a role, because some of that oil can still go out to China from Iran. So China could play a big role here.
But surely China can't really change Iran's mind. And similarly, China and US are supposed to be in the middle of a trade war. So how do you see that as being a possibility?
It's unlikely. You're right. At the moment, it's still a case of trying to get US and China on the same page. But realistically, it's when Iran starts to feel the pinch, and the US is already starting to feel the pinch. But when they start to feel the pain points at some point, you hope that will get them both to the table to find some kind of compromise. The fact that there's been exchange of compromises, even though they're far apart, suggests there is willingness there. And as the pain points increase, you can only hope that will find some middle ground.
Paul Hickin from the Petroleum Economist, many thanks indeed for your time. OK, time for a bit of a roundup now. And Russia's government has slashed its economic growth forecast for this year and next year amid the ongoing impact of its war in Ukraine and Western sanctions. The Kremlin says President Putin's regime is taking the right measures to ensure economic stability. However, the economy shrank at the start of this year for the first time since 2023 amid tax increases and high interest rates. eBay has rejected the $56 billion takeover bid from GameStop. The e-commerce firm said it had doubts over the financing of the deal and said its own turnaround plans had boosted growth. Many analysts were sceptical about the half-cash, half-stock bid from the video game retailer for a company nearly 4 times its own market value. And the US state of Texas is suing Netflix over accusations that the company collects users' data without consent and uses an addictive design to keep them hooked. Texas Attorney General accused the streaming giant of spying on citizens and said it records and monetizes billions of pieces of user information despite suggesting otherwise. Netflix says the lawsuit lacks merit and it complies with the law. Well, that is all for Business Today. Stay with us here on BBC News.